Hi, everyone. This is Jeff Praisman from Interactive Brokers, and it's my pleasure to welcome Will McBride and Dimitri Pargamatic back to our option webinar series with Market Chameleon. Hey, guys, Happy New Year.
Yeah, Happy New Year. Thanks for having us.
Happy New Year, Jeff. Thanks so much for having us.
It's our pleasure. It's always great to have you guys on here, and very excited for today's topic, trading butterfly option spreads.
Yep. So thanks, Jeff. I guess, do you want me to go right into it then? With the butterflies?
Yeah, let's roll.
Yeah, you know the disclaimer.
Yeah, let me just, let me roll down here. And this is the disclaimer really quickly. You guys could read it as we get ready. But what I'll do is, I made a short outline what we're going to discuss, and we're going to set up a butterfly spread today. I'll show you an example what it looks like in a payout diagram. We'll go over some of the risks, rewards, outlooks of a payout diagram, ways to do analysis on it, and then we'll do a screen. So I think we're going to try to cover all of that today. And if you guys have any questions, you can put them in that chat. Will's monitor them, he'll read them back to me, and we'll save some time at the end for some questions.
Great. So you want to wait to the end to take questions?
Yeah, unless it's relevant. If you guys have a question on something we're on right at that moment, then I'll take the question since we're already everybody can see what's going on. So if it's relevant to something like right at the time that we're talking about it, we'll just stop me and we'll go over it.
Perfect.
No, good.
Let's
so
roll.
I think that's enough. So I made a quick outline, and this is just the things that we're going to talk about. We're going to set up a butterfly option spread. We'll talk about, what is your outlook when you do it. We're going to take a look at a payout diagram so you could visually see, the different, your profits and losses, how they span on different prices at expiration. We're going to talk about a theoretical value, and then we're going to do a screen. Okay, and the theoretical value is more of like, can we put a value on the spread and compare it to the market prices? And screen is, we're going to use a screener to kind of narrow down candidates and then look deeper into it in an options chain. So again, outlook, a butterfly spread, if you guys haven't traded before, it's kind of considered it's non-directional, and from that I mean it doesn't have a bullish or bearish bias. You could set it up two ways. One is you're looking for very small movement in the stock, or on the flip side, you could reverse it and you're looking for very big movement in the stock from the current price. And there is a way to give it a slight bullish or bearish bias, and we'll go over that, and that's by moving the strikes around on that butterfly. The next thing we're going to take a look at is a payout diagram, and I think just seeing it visually helps. It even helps me, even though I could kind of see it in my mind. I always like to look at it anyway and play around with change some of the parameters around just to see, how that butterfly at the end of expiration will look. Or you could even move the implied volatilities around, strikes around, and just make sure that it's lined up with your particular outlook in the stock. So we're going to take a look at the payout diagram. Theoretical value. This is important as well, because when we're looking at a trade, one thing we might want to do is create an estimate of what we think this trade is worth, and if we could either buy a certain strategy below where we think is worth, or sell it above, it's kind of like you're making a little bit extra, and that's what we would consider edge. So this would be a mathematical edge. If you're doing a spread and you don't have even a particular outlook, sometimes people just trade it for theoretical edge. But the idea there is that are you getting a little bit extra for taking that risk? So we're going to go over two ways to look at that, using historical stock moves and also looking at implied volatility. And finally, we'll just use a screener to help us narrow down the candidates, because there's so many different stocks out there, so many different butterflies. How do you narrow them down? You know, what kind of filters can you use? So these are the things that we're going to try to do as well and cover all those today. All right. So if there are no questions so far, well, I'm going to kind of move on. And the first thing I want to do is just show what a butterfly looks like in a payout diagram.
Yeah, Dee, as you're doing that, we have some people who aren't familiar with Market Chameleon. Could you tell them a little bit about who we are and what Market Chameleon is?
Sure. So, and I'm going to go right now to the Market Chameleon page, but what we do is we're a research platform. So we're really looking for people who are self-directed stock traders, options traders, like to do their own research, like to look at data, you know, benchmarks, statistics, valuation models. You know, if you could be trading a call or a put or different strategies, you could be trading around earnings or events. But to do that, you kind of need tools to assist you, right, to help you do research. So that's what we do is we help those self-directed traders, investors who like to do research, like to check historicals, like to look at benchmarks, valuation models, and you know, that's the community that we service.
Excellent.
All right. So and that's marketchameleon.com. I'm going to go, you know, before I go to a particular butterfly, just really quickly, I'm going to pick one out from a screener. I'm going to go to an options chain, set it up, but we're going to come back to the screener at the end, okay? And here are screeners, and you can see there are different butterflies. You have a call butterfly, put butterfly, an iron butterfly, and I'm going to go with an iron butterfly today, all right? But they all kind of look similar when you're doing that payout diagram. And here on an iron butterfly, you know, this is a screener for iron butterflies. And I'm going to just start out, let's just start out with SPY. And I'm going to pick one out here, you know, and I'm going to come back to this screener, but so far, let's just go first set an iron butterfly up so we have a visual what they look like even. And let's do, here we go. I'm going to pick this first one. We're going to go to January 21st, and this is going to take us to the options chain. And because I already clicked on one from the screener, what it will do is automatically in this options chain, it's going to January 21st. And down here, it populated the legs of that butterfly. And what is a butterfly? Essentially, you're doing either, you could consider a call spread and a put spread simultaneously, or you're doing a straddle and a strangle. All right, so you could be selling a straddle and then buying the wings for protection, right? So or you're selling a put spread, selling a call spread, buying a call spread, buying a put spread. So let's take a look at this one over here. So you could see here, the middle part we're selling right now. So you could see this is SPY. Right now, the spot price at the money is around $168. And what it picked was selling the call, 471, selling the put, 448. So now we're selling the straddle. And then it went out and bought. So this is right here. See, selling the put, 468 for 448, selling the 468 call for 471. And now we're going and buying the wings for protection. You're selling the straddle. Obviously, you have a lot of risk or unlimited risk. So by buying a put below, buying a call above, you limit your risk, right? So here we're going, let's start with the put, 466 put. You're buying that. And then the 470 call over here, 470, 357, all right? And let's take a look at what this butterfly looks like. And this is what I mean by, you know, this is a payout diagram at expiration. And here we have a bunch of different prices below. And at expiration, if you did the spread right now, it's $1.83 credit, right? You got $1.83 credit. So that's the max you would make. Or actually, the max you'd make is right at, if it closed at 468. So there's your sweet spot is right at that one point. And if it moves if it moves, you could see that you'll have to buy that butterfly back. If it moves violently to the upside, it would result in a loss because you got to buy back, or violently to the downside. And as you could see here, you're really neutral. You want that stock to sit right there at that 468 level, right? That's your sweet spot. That's where you stand to make the most. That's why here it's considered non-directional. You don't want it to go up. You don't want it to go down. You want it to like just sit there and collect all that premium that you sold it for. All right. And this is a $2 spread. And as you could see here, that the range that it's profitable is tight. It's very small, but here the payoff is very big. What are you risking here? You could see here I'm hovering over it, $17 to make a $1.83. So think of it this way: I'm risking 17 cents to make a $1.83. So you could see there that ratio is very large. It's whatever 10 to 1, right? So you got to look at 10 to 1 ratio, but you got to be right where that stock ends up at expiration. And I'm going to show you really quickly. I'm going to move this around a little bit before we get the valuation, but the payout diagram is very important because you want to know, well, what am I risking and what do I stand to make if things go my way or the stock reaches my outlook. And let's say you do think that I think there's a better chance that it's going to rally a little bit and you want to pick that strike. We could move all these strikes up very easily through here. So see all these strikes, I'm just going to move them up. I'm going to move this middle part to 470. So let's go 1, 2. So now I moved the whole butterfly up. I'm going to reload that strategy. And you could see now that sweet spot's at 470, right? So here's where the stock is currently. And now my max gain's at 470. So here the credit's a little bit different, $1.78, risking 22 bucks to make $1.78. But now it's got a slightly bullish bias. And I could continue doing it if I wanted to go higher or lower on the other end. So I'm going to go down now just to show you here. I'm going to come back. Now I'm back at 468. Let's go down to, and this here, it's going to shift lower. So let's load that strategy. Now you see I got a little bit of a bearish bias here, right? So those strikes that you pick are important. It should line up with your outlook and whatever stock that you're trading. But wanted to show you really quickly how to move those around. Let's come back to the original one at 468. I'm going to reload that strategy. And here we see, that right now it's $1.83 credit, midpoint $1.87. So you really, if you're selling something, you always try to get better, right? So your midpoint is kind of your reference price, where as options traders, that's where we kind of think of the market fair value, right? So you have a bid, you have an offer, you have a midpoint, and the closer you get to the midpoint, the better. If you could get above it, that's even great, but you always want to try to pay attention to where that midpoint is, because the further you trade away from that midpoint, the greater the fee is to get that execution on that spread. So that's another thing to keep in mind. Oops. Let me see. And now let's take a look at it from a valuation basis. And here's a question I do get before I go to the valuation of it. Like, what do we think that this is worth? Like, is $1.83 a great price? Is it not great? Is it fair? So it's another question we want to ask, because the risk reward, that looks pretty good if you think that the stock will sit there, right? If you think the stock will sit there at 468, then that's a really good, 10 to 1 ratio. So we want to see, well, what do we think this thing is worth? You know, are we selling it for a really good price? And by how much? And historically, how often would have this resulted in a profit, right? If we did this type of spread in SPY, you know, how frequently did that result in a profit, and what was the average value of it? And the other thing is we want to take a look at it from the implied volatility standpoint. So before I get into that, here's a question I get: why don't you just screen for butterflies based on implied volatility? Implied vol is high, the idea is you want to sell it. Implied volatility is low, you don't want to sell it, maybe you want to buy it. And here's the thing about implied volatility. Implied volatility, a stock doesn't have an implied volatility. Some people think that a stock has an implied volatility, but it doesn't. Implied volatility, it comes from option prices. So it's a derived value from option prices, okay? And it's a value, it's a metric that we use, the Black-Scholes model. And when you derive something from option prices, you have to pick, well, what option am I even referencing, okay? So SPY doesn't have an implied volatility, you could forget about it. That's not how it works. But what do we mean by, you know, implied vol is high and SPY or it's low? And we have industry benchmarks. One of the more popular one is a 30-day at the money, right? So if we had a 30-day option, constant maturity 30-day option, and it was at the money options, what is the implied volatility and how's it moving from day to day? And that's right here, 30-day IV, right? And that just gives us a general idea if something is high or low on that type of specific option, okay? So if we went here and went out further and found an expiration, 30 days to go, we found that at the monies like this, then that's kind of the option that we're talking about. But as you could see right now, I'm on SPY and this has 7 trading days to go. And maybe I'm not doing it at the money. Maybe I'm doing this option right here, where it's just 2% out of the money. So if that's the case, that 30-day IV does not tell me much. All right, that might be a completely inaccurate picture of what's going on in this particular option that I'm looking at, because it has different days to maturity. The strike price is further away than that, the money, and it's below. So now I'm looking at a completely different option, and I need to know historically if this option is high or low, okay? So that's how implied volatility works. So you can't really screen by one implied vol. It's really what you're trying to do, and you got to get it that granular. You got to get it that detailed to really assess if the implied volatility is high or low. And another thing here is, look what I'm doing here. You know, I'm selling options and buying options, right? Look, I'm buying a put, selling a put, selling a call, buying a call. So I'm not just selling here. I'm buying options and selling options. So if you're selling options at one implied volatility, but you're buying them at a much higher than they usually, then this IV rank means nothing, okay? So what are you really doing here is a skew, right? Look at the, besides the implied vols, there's a skew. They go up, they go down, and what you really want to know is based on today's implied volatility, 7 days trading to go, and how the skew is lined up. How does that look like relative to history? That's very important, and probably you're not going to find that 99.9% of the places. So let's take a look at that. So I'm going to do first the distribution theoretical value, and let's see what we think this is worth. So if we use 4 years of historical data, and we wanted to see on average, what did this strategy finish at, the average price, and we see that was $1.86. So kind of right in between, right? So it's kind of a fair value. You know, if you sold it on the bid at 183, that's a 3 cent, you know, negative theoretical edge. So 186, long term, we see it as that's a fair value. All right, and that's based on how the stock moved, actual realized returns of the stock over 4 years in SPY over 7-day period. And this win rate is showing us that if you did this trade, similar trade at $1.83, right, $1.83, that it resulted in a profit only 9.9%. And it shouldn't be that surprising because look at that. You know, you got a very small range here of profit, right? Anywhere outside that, you could see, boom, you're out. So given this scenario, what we know is that it's a low probability, but a high risk to reward strategy, right? So we know that the payoff is 10 to 1, but history tells us here that you got a 10%, basically 10% historical probability of a profit. So that's based on historical actual stock returns. So let's go to the next level and analyze it another way and say, well, that's based on how the stock moved. How is this usually priced though in the market, right? Are we priced based on implied vols here? Are we priced high? Are we priced low? Are we priced right at where we should be? And that's when we're talking about, we have to look at the historical implied volatilities on similar strikes, similar days to expiration, similar situation, similar IB rank, all that we have to take into consideration. And then when we run that analysis, we want to see where does this usually trade at, right? Is this high, low? And that's the IV Theo here. So here we go. So we could see here, these are our stats. We could see here, we got 7 days left. So now we're looking at 7-day IV, not 30-day. And we see each of these strikes is a different percentage away from spot price. So we got to go back and look at daily implied volatilities historically for each one of these and figure out what this should be, what this historically traded at. So here we go. Historically, the average credit $1.71. Okay. Low $1.59, high of $1.85. So we're kind of on that high range. So from this perspective, from where the implied vols are usually pricing it, where the markets are usually pricing it, it looks like there's some theoretical edge there, right? Because if we revert to that, if the implied vols, if just stock sits here, if just the stock stays here for now, and those implied vols and the skew reverts back to that average, then we got already, like, we got the 12 cents of theoretical edge. Okay, so two different ways I just did the valuation. One from actual stock returns, the other one, how do those implied vols usually line up? All right, everybody okay with that? Let me know if you have any questions. So, and why are we looking at, what do we cover here? As traders, what do we want to know? Well, it's important to assess, you know, what are my risks and what are my rewards? We want to be able to identify them, quantify them, make sure that they line up and make sense to you, right? If you don't know your risks, if you don't know your potential rewards, if you don't understand those rates, then you're kind of driving blind there. So we went over risks and rewards. The other thing we wanted to find out is, well, what are the market's price versus what we estimate, right? Because as traders, we look for a little bit of edge. And what does that mean? Doesn't mean we're going to necessarily be right or make the difference, but we're getting a little bit extra for taking that risk, right? So somebody is paying us a little bit extra to take on that risk. And that's where we're looking for that theoretical edge. And then finally, what it would be our outlook. and that's unique. I can't get it because there are many different ways to try to determine if you think you're bullish, you're bearish, you're neutral. So but that will be important too, is like, does this line up with my outlook? Do I think that we're really just going to be sitting right around here, bounce around back and forth, but we're going to tend to just trade right around here? Are we going to rally a little bit here, fall a little bit here? So that's going to be another thing that comes into play with experience. It's some guessing, it's some analysis there, but your outlook is important there, because you could see here, there's your sweet spot, 468. All right, so if people are okay with what this butterfly, what a butterfly is, the legs, the analysis here, we could kind of go to a screener and start looking for some potential candidates.
Yeah, let's move on to the screener, D.
Okay. So let me come back here, and this is going to be the credit butterfly, and I'm going to set this up. Let me just remove SPY. I have this set to SPY. So now we got a bunch of different potentials. 4,279. It's defaulted to the first monthly expiration. So let's take a look at anything expiring next 30 days. And you could see I got over 14,000 possibilities here right now in the next 30 days. So we want to start to kind of narrow them down just to see if we could find something worth looking into further. And if you have your own watch list, some people just like to screen by their own stocks. You could create your own watch list and do that. If you want to just screen, you got other ideas over here you could screen with. If you want to look for stocks only, S&P 500, Dow Jones, so forth, you could narrow them down further that way. But for now, I'm just going to keep all of them in there and use some of the other filters. So here, let's first set one with theoretical edge. So we want to see somewhere where we could do one, but it looks like the markets right now are lined up where we have a little bit of theoretical edge. They're paying us a little bit extra. Maybe I'd put 5% here. So you could see here now, I narrowed down this list to 1,000. And what this is doing is saying, okay, here's the market price. Here's where we think the theoretical value is. So if we take the difference divided by our risk, you could see that some of these have some decent theoretical edge. In other words, if we use historical stock behavior, how they traded, and we estimated that value at the end, right now, some of these have a theoretical edge. We could also kind of do it by win rate as well. And the win rate is just telling us if we took the market prices today and we compared it based on how the stock ended up in those days, how often would have it resulted in a profit, right? And we shouldn't see huge amounts here because this is not a high probability, but I'm gonna, just to narrow this down, I'm gonna just say, show me, I already have a theoretical edge of 5%. Show me the best win rates right now for each stock. So we got like here, BAC, Facebook, so it's showing us, the best ones. Another thing here, as I'm looking at it and I'm seeing some of these, how they're lining up, and I see the expirations, this little E here, this is telling me that there's going to be an earnings that covers that expiration. So you see I'm on Bank of America right now, hovering over January 19th, there's an earnings. So January 28th expiration will cover that earnings event. That's something to keep in mind. Now, the screener is taking that into account and it's going in earnings mode. So it's looking at actually historical stock behavior around earnings. Similar situation. Some people like to play those, some don't, but it's another, thing to consider, that during events, the stocks can move. right? Those event stocks will move, and you need to be aware of those because you're really playing with these that there's not going to be a lot of movement. So I'm going to come over here as well, and this here is telling us our risk versus reward, right? So here we see this is a dollar spread butterfly, right? So if we could sell it for 82 cents and the stock finishes at 49 bucks, we collect 82 cents. That's our reward. If we have to buy back for $1, right? We sold it for 82 cents. We have to buy back for $1, we lose 18 cents. So you could see here your risk versus reward, you got a gain of 455%. So some of these, if they work out, you know, they're big wins, right? And that's how you would look at this. So if we just, you know, we could just sort it by this. So here we go, you know, 2 to 1. Here we go, 2 to 1, 2 to 1, 2 to 1. So those are different ways that we could use the screener to kind of narrow things down.
Hey, D, we're having a question. Someone must have come in late. He's asking, is this screener from Interactive Brokers? Can you tell him a little bit about where this screener's from again?
Well, this screener is on Market Chameleon. So I'm showing you right now on the Market Chameleon platform. And if you go to screeners here, you have different option strategies, and you know that's where you would go. And right now I'm on the iron butterflies right here. Short at the money's, long the out of the money's wings.
And this screener, I'm pretty sure, is a premium product. There are lots of free features you can check on the site. Again, it's a web-based platform, marketchameleon.com. I put the link in a couple places in different questions, but that's where everything being discussed is on that site today.
Yeah, exactly. So that's where we're using it, from marketchameleon.com. And let's take a look at, we could take a look at an earnings one, actually. You want to take a look at an earnings one, Will?
Sure, that'd be great.
Let's take a look at, here, let me see if one's coming up closer. I'm just gonna sort these. So these have events. So this isn't, this QQQ obviously doesn't have earnings. We're looking for an E. Another thing to look out for are events. So if there is a non-earnings event, like the one I'm covering over right now, ABBV, has a 40th annual JP Morgan Healthcare Conference, January 11th. So that expiration is going to cover that. That could also be an event that potentially can move the stock, right? Because somebody from the company is going to be talking. We don't know what they're going to say. You know, they could say something that investors could pick up on and could be potentially a catalyst for a stock move. But you have to be aware of certain, if not only earnings, but there are other events happening between earnings that can still impact that stock price. So let me take a look for an earnings one. So here's one, Citigroup, right? So Citigroup is going to be coming out January 14th. So that's right on that expiration, right? So it's in a couple days. I'm going to click on this, and this is going to take me to Citigroup options chain where we just did that analysis. And I'm going to take a look at the butterfly in Citigroup. We're going to use an earnings perspective this time, right? So it's not just the regular days. We're going to take a look at an earnings perspective. So here we are, Citigroup, January 14th. Here's the earnings. And here it automatically populated the legs of that spread for us because I did it right from the strategy screener. So let's load that up. And here's what it looks like right now, right? So we see here in the green, this would be profitable expiration. In the red, it would be unprofitable. We see $1.83 credit. And what I want to know, you know, or maybe, and you guys might want to know, is if I plotted the historical earnings, right? If I plotted the historical earnings moves, you know, I took the percentage and I said, you know, plot the percentage moves away from spot price, and how many of those landed in the green, how many landed in the red, right? We would just want to see, is it tend to not move that much and they land in the green, or does it tend to move a lot and most of them are in the red? And maybe it's worth flipping this, right? So let's do that first. And I'm going to plot the last 12 earnings moves. They're going to be lines like this. So here's the current spot price. Here's a standard deviation move to the upside and one standard deviation move to the downside. And now we're going to plot the earnings moves and see where they land in this payout diagram. So I'm going to come down here and say, show me the last 12 earnings moves, right? So these are, see here, earnings move, display earnings move. Let's do the last 12. So here we go. So you could see that a good amount of those landed in that green area, right? So you see here, there's clustering right there around that green area. What also I see is I had an outlier up here to the upside. It looks like, you know, it was up 4% the one time. So if that happens again, we see that's landing in the red. And some of the ones to the, and really when they escape that little green area, it looks like more often it did it to the downside than to the upside. So far in the last 12 quarters, we see that a lot of them land in that green area. So for that strategy, that would be good. Some of them that landed outside tended to lean towards the downside than the upside, right? So those bigger moves so far tended to be to the downside. So that's really quick insights into this strategy, applying those earnings moves. And let's go to that distribution, Theo. And we're going to see what we think this is worth. So I got to change this back to only earnings periods. So if we used historical stock behavior and we plotted this against historical earnings, how it behaved from now to expiration, covering earnings, we see the average price is $1.53. So that's about a 30 cents edge. And that historical win rate, 62.5% of the time, what it's saying is that if you sold it for $1.83, 62.5% of the time, you'd have been able to buy back cheaper, resulting in a profit. So one more thing we're going to do for the evaluation is we're going to come back to our IV Theo and say, okay, that's using actual historical returns. What about how the options are set up now, right? How are the options priced versus how they are priced historically? And that's in the IV Theo. So here we go. On average, we would have gotten $1.80 credit. Right now, $1.83 credit, so that's a little bit extra than the average. Here's the range, as low as $1.04, as high as $3.06. So we're not anywhere near that, you know, that high of a range, but $1.80. So we still have, you know, some edge there. So if everybody's okay with that, I am going to open it up, you know, to questions. No questions.
We did have a question about win rate.
Yep.
They were asking, when you're looking at win rate, does it take into consideration of the commissions?
No, because we don't know your commissions. That's up to you. Everybody has different commissions, and you just put that in. But the win rate is not the statistics. The statistics are not meant to replicate exactly what's going to happen in the future. That would be ridiculous, you know. So anybody who's like, you know, throw in my commissions, the bid-ask spread historically, and then I'm going to replicate that going in the future, that doesn't happen. You know, that's like, you know, the probabilities, the statistics are there to help us along as guidance to see where we at here based on his history. Like, are we high? Are we low? Where do we think our potential profits are, potential losses? So in no way, shape, or form are we ever going to try to replicate a strategy that will say that this is exactly the spreads, the commissions. That's not the point of it. This is a research platform where you're using the data to help guide your decisions, you know, but you're not going to create a model that you're going to plug it in and you're going to get an exact result like that. So no, this has nothing to do with like commissions or anything like that.
There you go. Mike Chandler's asking, since each contract in Strike has its own implied vol, when platforms like Thinkorswim or TradeView plot a line for implied volatility, do we assume that it is the at the money strike and next expiration or some average?
So I don't know what what the other platforms are doing, but what my point was here is that they will show you the current implied volatility, right? So they should be able to do that because that is an easy thing to run. So just taking the price of the option, putting it into, a option pricing model and spitting out an implied volatility, they should be able to do that. So you should be able to see an implied volatility by strike. But what I'm getting at is that if you're screening by an IV rank, right? An IV rank is not ranking each individual option unless you're keeping track of an option that is very similar to this, right? This has 3 days to go. This is 9% out of the money. So think of it as if an IV rank, right, in Citigroup, what is an IV rank? It has 2,000 different IV ranks right now, right? If I had to create an IV rank for Citigroup, I couldn't use one IV rank because each of these options should have its own ranking based on what is it usually, right? Like a 3-day option does not trade the same way as an option 27 days. And a 27-day option does not trade the same way an option with 46 days because there are more days, there's more uncertainty, there's more things that could happen. Not only that, an option that's let's say 20% out of the money does not trade the same way as an option that is at the money, right? They trade at different levels. So there's no way for you to say that just show me an IV rank for, give me an IV sort, filter butterflies by an IV rank. You can't do that because a butterfly has 3 different legs, right? 3 different legs. Not only do they have a different, do they have different implied vols, but they have a different relationship to each other, right? So that's what you're looking at is the relationship, the spread between those legs. So an IV, there's no way you could do that through an IV rank. What you're doing is you're looking at different expirations, different strike prices, and the relationships between them, which is a skew. Okay, that's how deep you have to go to really get a valuation. But your broker should have the, just the market itself, the current market, they should be able to do that simply because that is the easy part. This you just plug in numbers. You don't need historical data, benchmarks, analytics. You don't need any of that. You could just plug in numbers and get the current implied vols.
All right, excellent job, D. Rick is asking, and again, I'm going to read these typed in questions. So for those who don't know, we do a daily live Market Chameleon YouTube show, and we allow the people to come in and ask their questions live. So it really leads to a much better interaction with the questions because I'm not exactly sure what Rick's saying here, but I'm going to read it to you and you can make a decision, D.
Okay.
He says, if we want to do weekly butterflies, can we display inside, outside moves of expectations rather than display earnings? So I'm not exactly sure what he's saying. I'm wondering if when you're plotting it out, if you can put different price points where the butterfly may look at different prices. I'm not exactly sure what Rick's asking there, but
yeah, I'm not sure either. Maybe if if we could bring him on live, I'm not exactly sure. He might be.
Well, we can't bring him on live here, but Rick, if you want to come on over to our pre-market show tomorrow, again, I'll put a link into the YouTube channel. You just register, or you come on. Can you just show on Market Chameleon how they can see our live webinars if they're on? Again, this is a free platform. People, anyone can come to it. You can have a watch list for free. We put out emails every day.
Exactly. There's a premium.
No. I know, but you can come to the site. There's no charge to come to the site.
You're right.
And there are lots of free features, and one of the features is our morning show. And you could come and ask this question live because I don't exactly understand it tomorrow morning, but
yeah,
it starts at 9 o'clock. You just go to videos and it's on there.
Yeah. So part of what we do is in the morning, every morning from 9 to 9:30, we try to, we take questions, or we discuss tools, we discuss market community tools, we just discuss strategies like we're doing today. And really the idea is that, from my experience trading, it's not just about like a tool, or it's about experience and knowledge, right? That's what trading, as long as you're learning, you're getting experience, your knowledge, you're tweaking. And the idea, and that's why we do the show from 9 to 9:30. It's free. Anybody could ask questions, come on live. We discuss different things. And people can talk about things that are working for them, which would be great, give people some insights. Or you could talk about things that you've experienced that didn't work, or, something happened you didn't expect. We could talk about, different options, different trading strategies, earnings, and so forth. But that's what we try to do from 9 to 9:30 every day. And if you go here to the videos, you'll see the old ones here. We keep them in there, so you could go and just play them, but they're on YouTube.
Yeah, but again, a lot of the features, well, I think all the features except these videos that Dimitri showed you today are a premium service. Someone was asking, I think Victor was going, is there a trial period for the premium features?
Yeah, so there's a 7-day week free trial. So you could come on there, you try it out for 7 days, and if it's not for you, you don't like it, you just cancel before the 7 days, and there's no charge. So there is a 7-day free trial to the services, right? And then we also have a pretty big, I think, community. We have their members. They have a Discord group, right? So their Market Chameleon members have a Discord group. Answering questions. We have some Market Chameleon members actually coming on the show who have been members for a while now, know their way around. They do even webinars for us, showing how they use it. And we try to put out like instructional videos on YouTube as well. And there are things in there you could start out for, like unusual option buy. I think a lot of these reports here, you could just start out. We put them out for free. So if that's it, well,
yeah, we did have some more questions. I'm just
okay.
If you want, this is from Rick. Oh, that I guess we asked. If we want to do weekly butterflies, can we display inside outside move? That was the one he asked.
I think
right?
Yeah, I think you asked that one.
All right, this is from Marius. If we make the wings wider on a butterfly, will the POP increase?
You mean
Not
like
exactly?
So you're saying like take these wings out? Yeah, you could do that. I mean, here the question is, I'm buying the 470 call, so I'm going to take that out. Let's take it out to, I don't know, let's say 475, right? And then if I want to take this wing out, instead of buying the 466, I'll do the 461. So I rerun that strategy just to see what that will look like. So you expanded it, right? So now you have, so what you did was the area that the green area, the profit area, that did expand, but the trade-off is that, your risk reward ratio changed as well. So that's kind of like the trade-off there, right? And look, these are structured based on your outlook, where you think. It's a very good question, but it is based on, that's why you have this payout diagram, because if you have in mind, I think it's going to be within this band, right? Like between whatever, 460, 470. Once you decide that and you feel confident about that, you know, that's why the payout diagram really helps, right? Because you could visually just see it, where your profits and losses are, you know, what, you know, where you should be selling it at. You know, we could change the prices here to see if we want to, if we sold it higher, how it would look like. But you know, that is important, because, you know, as traders, we want to know, right, what are we risking here? What are our potential rewards? Does this fit into our outlook? Are we getting a good deal for this trade? Are we getting a good price for it? These are all important questions, right? And these are the things we kind of try to go over today.
Excellent. Judge's asking, any plans to add a BWB screener in the near future?
What kind of screener?
It's a good question. I'm not exactly sure. I was going to go to Google and search. What's a BWB?
BWV?
B. Boy William Boyd.
Boy William, I'm not sure. I don't know.
Blended wing, butterfly, maybe.
Broken wing butterfly?
Broken wing butterfly.
So a broken wing butterfly is, that's true, because how do you break it, right? There's that also, it depends on your outlook. The broken wing butterfly, right now, no, you'd have to kind of go in there and then start breaking it up yourself, like, you know. But the idea behind it is, I don't have time right now to go, but you start changing the ratios, or spreading it out. So I could just kind of like, you know, I'm not going to change the ratios, but I could just expand this wing as well, like to 480, right? So it'll look a little bit like that. But the way you start doing it, it's going to depend on your outlook at that point, you know, of where you want, you know, what price ranges do you want to cover, right? Where do you want to set your limit your losses, right? Where do you want to cover your risks? And so there are too many different variables, too many different ways to set that up. A butterfly is kind of simple in the sense that, you know, it starts out, you know, with a strike, you know, that you do, you're like, say, at the money, and then you're starting to go out wings. So it's a little bit more simple. Once you get into the broken wing butterfly, I think Mike, actually, I don't know if, you know, long-term market chameleon uses broken wing butterflies. Maybe he could give us some insights, but he's good at that.
Mike Chandler, you're saying?
Yeah.
I think he left after his question was answered and said, thanks, guys.
Okay.
Great service, highly recommended, with his parting words, which is nice. Thanks, Mike, for saying
Awesome.
that. Again, I've said it a couple times. I'm not pushing anyone to come to the YouTube channel, but come on tomorrow with the broken wing butterfly question. Maybe there'll be people in the community who trade them regularly and can, you know, it's amazing how almost every day on the show we get someone else who's showing something, some way that they're using the chameleon that Dimitri and I haven't even thought of. So there's so much information on the site. It is quite incredible.
Yeah. So there are tools to analyze the broken wing, but not to screen for it. You know, not, you know, right now, if anything, I'm probably gonna put in a calendar spread screener before I would do the broken wing butterfly, because I've been working on that for a while.
And we've been getting a lot of requests for it, haven't we?
Yeah. So the calendar spread, diagonal spreads, was probably, out of the request list, were the top ones. So,
all right. Well, I think we got every question answered. Any last questions, anyone? Any questions about the site? Any questions about Dimitri, myself? You got a couple minutes to ask them.
Yep.
Any last words for the IBKR community?
Well, everyone, thank you for joining, watching the webinar. We really appreciate it. You know, interactive broker community has been great. We've, you know, had people come over, watch the shows, contribute. You know, we're customers of Interactive Brokers, and really our beginning, our training was from Timber Hill, which was a market making outfit by Thomas Petterfree, you know, before Interactive Brokers. So, you know, so it's been great. It's a really good community, and a lot of people contribute, you know, from Interactive Brokers. So thank you for joining us. Stay safe out there. Hope to see you guys come over, watch our show in the morning.
Thank you so much, Will and Dimitri, for coming on today. And we'll see you next month for your webinar in February.
Great.
Yeah, every second Tuesday at 2 p.m. I think is our schedule. So Ali, thank you so much. Thank you, Interactive Broker community. You've been very welcoming, and we invite you to come over on any time to see our show in the mornings. Thanks so much, guys.
All right, thank you. Bye.
Thanks, everyone. Stay safe.
Bye.
Bye.